Thanks for joining me here at NTD Business. Just a quick update on housing first. The interest rate on a 30-year fixed-rate mortgage leapt back over 7% last week for the first time since last fall. This is according to the Mortgage Bankers Association Wednesday. This was the highest since November. And 3 large tax preparation firms sent extraordinarily sensitive information on tens of millions of taxpayers to Google and Facebook parent company Meta over the course of at least 2 years. This is according to a group of congressional Democrats Wednesday. They say some of that data was then used by Meta to create targeted advertising to its own users, other companies, and to train Meta's algorithms. The lawmakers say their findings reveal a shocking breach of taxpayer privacy by tax prep companies and by big tech firms. Some of the firms include H&R Block, TaxAct, and TaxSlayer. The report said highly personal and financial information about sources of taxpayers' income, tax deductions, and exemptions was made accessible to Meta. Taxpayers' data was also shared with Google through its own tracking tools. H&R Block said on Wednesday that it takes protecting client privacy very seriously and has taken steps to prevent the sharing of information. And joining me now is Scott Schober, cybersecurity expert at BVS Systems. So these tax prep firms sharing tax-related data, I mean, how big of a privacy violation is this?
Oh, this is huge. This is on a much larger scale and much larger proportion than your typical data breaches with big data that we hear about often, because this involves so much more personal information about those that filed the taxes. And I estimate between the 3 tax firms, it's probably well over 100 million individuals potentially that could be affected over the years if you look at their customer bases and size, number of filings that they actually have done. It's tremendous.
I mean, what kind of information are we talking about here?
Yeah, so it's the obvious, it's the names, it's phone numbers, it's email addresses, but more importantly to this particular case, it's the tax filing information. It's things like their filing status. Is it filed jointly or not? What's their adjusted gross income? Maybe the size of their tax refund, things like that. Information that it gets in the hands of a cyber criminal that potentially could be devastating and could be used against many people.
Yeah, I mean, obviously this is very serious, but if you could paint us a picture of how this actually impacts American taxpayers.
Yeah, sure. Well, the average American taxpayer might use a service to save some money, and they don't understand all the little loopholes and things within the taxes, and it's done all the time, and it's very convenient and helps them. However, what they're not hearing, they're not giving consent, and they're not hearing what they're giving away. And what that is these tax companies are basically saying, we're taking your personal data and we are now selling it to third parties. We're selling it to giant tech companies. Google and Meta in this particular case were 2 that were identified. They in turn have third parties that they have agreements with, and they share and sell this information that's collected, this metadata and actual data about individuals. And that's what's so concerning, because it's going through multiple hands. Money is being made off of, in a sense, the Americans' backs, because our personal information is being sold. And it's not just, again, a name and a phone number, some basic information. It's intimate details about us and our finances. That's where the huge concern is. And every American that's using these services should be very concerned. And that's why there's a probe and an investigation to verify what did or didn't actually get divulged. And this is going to be an ongoing thing, and I would estimate it's going to probably be billions of dollars if they are found guilty in fines and arbitration and notifying customers and trying to clean up the mess. It will be devastating.
So you mentioned money is being made here. So I guess you're saying that this is actually on purpose. It's not an accident.
Oh, yeah. This is part of their business model. This is how they get a return, in a sense, on their investment, by having these relationships with companies. And it's not unique to this industry, I should point out. This is done often. If you think about it, something as simple as our smartphone, when we download an app, we opt in, we agree when we say, I agree to the terms and conditions that nobody reads. And in those terms and conditions, it says, this company has the right to collect data and sell data about you and your contacts that you have in your contacts and what web searches you did and so on and so forth. So we're part of the problem. We're not reading what we're agreeing to. the legalities of these big tech companies, they make it in small print that nobody understands unless you're a lawyer and you don't have time to read it. So it's kind of a catch-22. There needs to be some level of regulation on this. And usually when the government steps in this case, the FTC is going to be analyzing it very closely, and certainly federal investigators, they're going to be imposing fines if they do find them guilty. And it looks pretty clear that there's been a lot of things that they've stepped over the line and pushed it to the point where it does affect the American consumer, and it does affect the data privacy, or at least we perceive we have data privacy when we fill out our secure tax return and we submit it online. Guess what? We really don't, and that is concerning.
And some of the companies here have responded. I'm sure you're aware. What's your reaction?
Well, it's very typical. It's sad to say, but large companies, I don't want to pick on them, but it's very easy to. In this case, a Google or Meta, when they get slapped on the wrist with a fine for X number of millions of dollars, and even in some cases in billions of dollars, as in the past, they could shrug it off because they've got deep pockets, they've got a legal staff at their beck and call that can fight these things and drag it out in court and settle it for pennies on the dollar. And that's often what happens, unfortunately. The challenge is they can afford to do that. If you contrast that to most startup companies and small businesses, which is kind of the backbone of America, we're still adhering to these data privacy laws that are expensive and they're hard to litigate and adhere to. The big guys can afford to do it. So what it really does indirectly, they pay these fines, they reduce the costs and negotiate it down. It squishes innovation and stifles small businesses. And that's not good. And startups, I should point out too, because they can't compete and maintain these levels of data privacy laws and keep data safe. It's just not fair. It's an unfair playing field. And in a sense, they're using it to their advantage by saying, yeah, well, we don't agree to this. We didn't really break any laws, or we'll fight this out in court. And they end up just paying fines, even though they know they did things that were wrong.
I mean, there are a few parties here. We have Google, Meta, and the three tax prep firms. Who's to blame here? Who gets the majority of the fault?
Well, I think unfortunately you have to kind of go back to the big tech companies, because big tech is behind a lot of this. What they're doing is they're condoning the use of what's called tracking pixels, which is basically software code that's used on websites. So if you're on a website and you're completing your tax form in this particular case, it's picking up all these different pixels or the different things that we type in. It parses it, combines it, and then it can take that and use that as data, and it could be in reports or whatever else, and then sold to the highest bidder. And in a sense, that's what they're kind of doing. So they're kind of condoning it. The tax companies, unfortunately, I guess, are making money on it, and they're kind of turning their head to the big tech companies that are paying them money for it. So they're both guilty. Who's more culpable than the other? I don't know, but I think when you look at a Goliath like a big tech company that knows what they're doing and knows what the potential damage of this, and they know very well, they're well versed in the privacy laws of data protection, better than the tax companies. And therefore, the onus, in a sense, should be on them to do what's right for the consumer, because that's the ultimate customer that's paying.
And let me just end on this. Do you think it's possible to prevent this from happening in the future?
Yeah, yes and no. If the big tech companies were more transparent, it would make it a lot easier. If there was a little bit more government oversight and regulation, it would certainly help. It would keep them in their lanes and allow them to focus on their core business as opposed to their, I call it the side business of selling data, selling our data to third parties, and that's really what they're doing. And it is wrong. It should be corrected. And laws such as that are enacted in the EU are preventing this from happening. A lot more has to happen here on U.S. soil, though, to prevent this from happening further.
All right. Thank you so much today, Scott. It was a pleasure hearing your insight.
Yeah, great to join with you. Thank you. Stay safe, everyone.
And moving on, U.S. consumer prices saw their smallest annual increase in more than 2 years. The CPI report today showed that inflation is subsiding. Year over year, the CPI is at 3.0% in June. That was the smallest year-on-year increase since March 2021. The previous month, it was at 4%. So we saw a 1% annual decrease. The considerable slowdown in underlying inflation sparked a rally on the stock and bond markets. Some investors are convinced the U.S. central bank's fastest monetary policy tightening cycle since the 1980s was drawing to a close. So what contributed to the CPI in June? Was mainly the rises in gasoline prices and as well as rent. But the price of used vehicles decreased last month. Food prices ticked up 0.1%. Grocery food prices were unchanged amid further declines in the cost of eggs as well as cheaper meat and fish. We saw a 0.8 increase in fruit and vegetables. Now, core CPI rose 4.8% over the last 12 months. And now joining me is Joseph Trevisani, senior analyst at FX Street. Now, Joseph, 3% annual inflation, is this a milestone? Are we still far off from the Fed's 2% target?
Well, we're not very far off considering where we were just a year ago at 8 and 9%. This is a very good number. It's interesting that the Fed's original diagnosis, that this would be a transitory event that was prompted by the supply shortages and the great spending burst out of the federal government, turns out, I think, largely to be true. In my mind, I don't think that it is really the increases in the Fed's interest rate policy that has engineered this particular fall, and very dramatic fall, if you will, in inflation. I think it has to do with the inflation itself is tapering off.
So you're saying this is a welcome print from the Fed's perspective?
I think it's very welcome from the Fed's perspective. However, the Fed is absolutely not going to say so, because the one thing the Fed doesn't want is for the market rates, the commercial rates, the credit markets, the treasury market to suddenly reverse in a very, very rapid and profound way. It doesn't want that. So it's going to keep up its rhetoric and probably one or two more increases to make sure that doesn't happen.
So you mentioned that this is a dramatic drop from the peak inflation last year in June, but I just want to point out something. Just because inflation is coming down, that doesn't mean consumers are paying less. So let's say if you're paying $3.50 for a gallon of gas, you're still going to be paying that even if inflation is decreasing. It just means that prices aren't going up as fast. I think it's hard for prices to go back to where they were once they have risen a lot. Am I right on that, Joseph?
You're absolutely correct. There's almost never, one of the rarest economic events is actual deflation, where prices actually fall. So you're absolutely correct. The impact on consumers is improving, but it is nevertheless dramatically more expensive across the board for almost all consumer items than it was 2 years ago. Gas used to be $2 a gallon. It's now $3.50. And you can go on and on about that, especially about the things that have to be purchased, food, housing, things like that. All of those things are dramatically higher. That's not impacted by the fact that inflation is only 3% this month, or last month, rather than 4%.
So I also wanted to get your thoughts on the dramatic drop. So the year-over-year rate dropped 1% from 4% to 3%. Now, is a big contributing factor of this decrease a result of simply how high inflation was at this time last year? Because basically, if you're comparing a bigger number, you're going to get a bigger difference, right?
Correct. There's absolutely, when you're doing a statistical comparison like this, there's always the effect of what you had before. And that was certainly true in the run-up, because in the run-up, we were dealing with less than 2% inflation. So you saw a dramatic move in the rates when prices went up. You're seeing a similar thing now because you're comparing to a year ago, which was just about the peak of inflation.
And you mentioned markets before. Is there a concern now because from this point on, we're going to be comparing to smaller inflation rates? And would that mean inflation might actually tick up from this point on?
I don't think so, because it took a while several months, 6 or 8 months, for the inflation to drop down substantially from its peak at 8. So you're still going to be comparing to considerably higher rates, probably more than double than what you have now. So I think we're still going to get a substantial change in the inflation rates, monthly rates going forward as compared to a year ago. We haven't really gotten out from underneath that statistical bubble yet.
Are you worried about, another aspect of resurgence of inflation for the reason that the stock market has been rallying this year. You were a trader before, these rallies could last potentially some time, and that gives consumers more confidence to spend, right? It's the wealth effect, and it's improving consumer sentiment, and we're seeing that from yesterday's small business optimism index that small businesses are more optimistic about the future, and that could be a leading economic indicator as well. I mean, I see a potentially good setup for a headwind for the Fed to tame inflation.
Well, it's interesting. The Fed's June projections have the end of the year rate at 5.6%. That would imply 2 more rate increases. I don't think consumers are going to. Consumers have been pretty steady and stable in their spending. They haven't dropped a lot. They haven't increased a lot. The wealth effect over time does promote more spending, but I think it's a gradual thing. And after the ups and downs we've had, and after all, the equity markets are still considerably below their peaks. And so I don't think you're going to get a tremendous wealth effect from where we are now at the current equity levels.
So based on today's inflation number, how many more hikes should we expect from the Fed?
Well, the Fed is being extremely cautious. I mean, the Fed has a good reason to be cautious. After all, their original transitory, temporary diagnosis on the inflation burst was correct, but it was out of time. And so for the Fed's policy prescriptions, the fact that they got the timing wrong is almost as bad as getting the direction wrong. So I think they're going to continue with probably what they have now, which is 1 or 2 more increases. But it doesn't seem like there is a reason to continue. 3% CPI is a huge improvement over what it was. The direction and the improvement has been very fast. It's been, if you will, accelerating a bit. So I don't see what the Fed is going to where they're going to go as far as keeping the markets convinced that they're going to hike right through the end of the year and into next year. I don't see that. They are, as I said earlier, though, very careful to prevent a commercial change, a change in the commercial rates, where the credit market rates, particularly the Treasury rates, come off hard because they think the Fed is finished.
I mean, how worried is the Fed about a resurgence of inflation?
At the moment, I don't think the Fed is that worried about a resurgence of inflation, because what it appears now is that, as I said, that the Fed's initial diagnosis, although the timing was wrong, was correct. That it was a huge problem with the supply chains after COVID and after we shut down so many things and so much of the economy. The economy is phenomenally complex, and it took time to get that back into position. In addition, the, I would say, unnecessary spending by the administration fueled that. And it came right on top of that supply chain problem. So if that's the case, and the Fed, we were actually right, they're not going to admit, I think, any of this stuff in their rhetoric, but it does seem to be the facts on the ground. It does seem to be what's happening. So once the Fed has sort of satisfied its need to be tough, I think they will ease off, and I don't think we'll see any more rate increases.
This drop is a big contributing factor, the Fed's rate hikes, because there is a lag effect. I'm wondering if we've seen the full impact of that.
That's a very good question. And one of the most difficult things to determine is that type of impact from Fed rate increases. Remember how that increase works, though. It generally works. The idea is that it slows economic growth, and that's the impact that it has. It slows consumer spending, slows economic growth. We haven't seen that. So that's why I say that I think there's been less impact from the Fed's increases than from a simple economic change because of the origin of this particular very, very unusual burst in inflation. We have to remember, the U.S. economy and the world economy was never shut down deliberately in a space of 2 weeks, which is what happened back in 2020. To expect that we wouldn't get an unusual result from that, I think, is wrong.
Right. I mean, in the past, whenever the Fed raises interest rates by this much, we've always had a recession. So, some people are wondering if we've not seen the full effect yet because the U.S. economy is very debt dependent. I mean,
That's
it
correct.
makes sense, right, that if we've seen the full impact of the interest rate hikes, we would see a bigger effect.
You're absolutely correct about that. The U.S. economy is debt dependent because so much of the U.S. economy depends on consumer spending. And consumer spending is, certainly credit card spending is tied to interest rates. There's no doubt about it. But it's also tied to jobs and growth, both of which have not changed. You're absolutely correct that when the Fed increases this quickly, this much, it has historically almost always resulted in a recession, but not always. And so we may have this time an instance of an exception which is logical because of the origin of this type of inflation. It's quite possible we're dealing with something that hadn't happened before. In fact, we know we are. Because as I said, no one ever shut down an economy in the space of 2 weeks like we did this time. So it's an interesting situation, which we're not at the end of it. But you're absolutely correct. There normally would be expected in a recession. And that's one of the reasons the markets have taken that as their paradigm, because historically it's correct.
So a lot of people are wondering what's different about this time, right? What's unique? Are you saying the lockdowns is the difference?
Yes, absolutely. I don't think we have never encountered a event like this before. When we have had, say, take Sandy, which hit the East Coast, it was a huge impact economically. We've had many hurricanes that hit the South Coast, the Gulf Coast, but there's never really been an event quite like this. The one that we can probably get closest to is the 1973 oil embargo out of the Arab states, which had a tremendous effect as well, a huge spike in oil prices. But we never shut down the economy. We never sent all the workers home. We never did this event before. So I think we are seeing that the uniqueness of the event has in fact produced a unique result.
But what's holding up consumer spending, right? Because with interest rates higher, you would expect consumer spending to go down. What's holding that up?
You would. American consumers are not afraid of debt. But they're afraid, and you can just look at the debt statistics in the United States. What they are afraid of, though, is losing their jobs and not being able to replace their jobs. And that is something which hasn't happened yet. If you look at the job market, it has cooled, but it still would historically be considered last month's numbers, NFP numbers, would be considered very, very good numbers. Not brilliant, not a boom, but a very good, steady job market. That's the case. So I think it is because of that job market that consumers have not pulled in and they're not particularly concerned.
And as well, the fiscal side of this equation, right? There's a lot of stimulus going into the economy.
Yeah, the stimulus, when you appropriate as much money as the government did, it doesn't all go out the door once. It takes time. It goes to particular programs. There's money from the first stimulus in particular programs that are not spent yet. So yes, even though we have stopped another burst of spending like that by appropriating another $2 trillion, still there's money flowing into the economy. But more importantly, I think consumers clearly are not spooked. They are not that concerned. They are still spending at very reasonable rates. And for the U.S. economy, there's no better prognosis.
All right, I think on that note, we should end it right here today. Thank you so much, Joseph.
Thank you for having me. It's always a pleasure.
China's producer prices fell at their fastest pace in over 7 years in June. This is bringing fears among economists and investors that the world's second largest economy is on the edge of slipping into deflation. The worsening factory gate price deflation and consumer prices inching towards deflation for the first time since February 2021 bode ill for China's economic growth. The demand for industrial and consumer products weakening is raising concerns about the health of China's economy. Momentum in China's post-pandemic recovery is slowing, and the weaker-than-expected inflation readings knocked financial markets. With the yuan falling and Asian stocks also dipping into the red, Beijing has set a target for average consumer inflation in 2023 of about 3%. Prices rose 2% year-on-year in 2022. China last month cut policy rates to boost liquidity and vowed to take measures to promote household consumption. And joining me here to talk about this is Brian McCarthy, Chief Strategist at Macro Lens. So now, China being on the brink of deflation, what's the consequence of this? I mean, what's the threat here? Just so that all of our viewers understand the stakes we're talking about.
Sure. So the consumer price index is 0 in China, but the more important metric is the producer price index, minus 5.4%. This is the lowest we've seen in many years in China. The problem with PPI deflation is that it really drives pricing power in the industrial sector. The industrial sector is still the heart of China's economy, and it's where a lot of the debt resides. So when their pricing is as weak as it is, again, minus 5.4% year on year producer price inflation, when they have that kind of lack of pricing power, revenues are very weak and debt servicing capacity is very weak. That undercuts the traction of any credit stimulus because they need to keep up high rates of credit growth just to make up for that decline in revenues in the industrial sector that occurs when we are in producer price deflation in China as we are now.
So it all comes down to economic growth, right? This will impact how fast China's economy will grow.
I think there are very, very important external drivers of the deflation in China. It's a threat of deflation on a consumer level, but again, they're actually in deflation on a producer price level. The key dynamic there is that suppresses revenue growth in the industrial sector, which then struggles to service its debt. So the banks need to basically provide credit to those entities just so that they can roll over past debts. And then less of the credit they extend is going to building new bridges and tunnels and factories, et cetera. So the producer price deflation really undercuts the efficacy of any credit stimulus that they might come up with. But I think the external story here is very important because China tends to struggle with PPI deflation when global commodity prices are declining, which tends to happen when Fed policy is tight. So, we're going to get another interest rate hike out of the Fed at the end of this month, most likely, further inverting the U.S. yield curve. This creates tight global liquidity conditions, which transmit through China via low global commodity prices, producer price deflation, and then, a mighty struggle in servicing debt.
So at the end of the day, what is China facing on the horizon because of all this?
Right. So what it adds up to is they have homegrown economic problems in that the credit-fueled infrastructure and real estate-focused growth model is at an end. They've decided not to go back to that. They don't really have anything to replace those growth drivers with. So you've got a very serious lack of confidence domestically, which is compounded by this international influence of very tight Fed policy, which transmits via low global commodity prices to producer price deflation in China. So they've got a homegrown economic problem that needs to be addressed, but the PPI deflation and this tight liquidity environment externally make it very difficult, if not impossible, for them to address the problem. It compounds the domestic problems. So the debt deflation story in China is hitting them from both sides. It's a natural byproduct of the after effects of a big property bubble that has burst. So you've got, asset price deflation, which, makes it more difficult to stimulate. We saw this in the post-global financial crisis. Western central banks had to get rates to 0 and still couldn't get policy traction. So you naturally lose monetary policy traction in the wake of an asset price collapse, which is happening domestically. And then you've got this external problem of Fed tightening, driving tight global liquidity conditions, putting pressure under the RMB, pressure on the RMB, and exacerbating deflation in China. So these things also make it harder to stimulate policy. They make stimulus less effective. And this is not a situation for which there are any easy answers.
I mean, for the regular Chinese citizen, I mean, these headwinds that the Chinese economy is facing, what does that add up to for everyday Chinese citizens?
A lack of employment opportunity, increasing hardship for small businesses, which were effectively hung out to dry during the pandemic lockdowns. They received none of the subsidies that small businesses in the West received to help them, bridge that difficult time period. There were some marginal tax cuts, but that's about it. So you've got a household sector that is suffering from its most important assets being in the wake of a price bubble that has burst. You've got small businesses still in a hole from the pandemic, struggling with a general lack of confidence. And you've got industrial China struggling with decreasing negative pricing power effectively, as illustrated by the deeply negative PPI inflation. So again, it adds up to nothing good. And I will say that the market is very excited about stimulus because in the past, China has found a way to stimulate its way out of these pickles. At least that is the perception. However, if you look at difficulties they had in 08-09, the U.S. QE'd us out of the global financial crisis. 2012 and 2013, Draghi did whatever it took and put that liquidity crisis back in the bottle in Europe. 2016, China stimulated, but Yellen backed off from the dot suggesting 4 hikes in 2016 and completely abandoned the rate hiking, which provided global liquidity. My point being, successful China stimulus in the past has come at the same time as global central banks were effectively stimulating. Okay. Now, if 6 to 9 months from now the Fed's in a panic and they're cutting rates like crazy, that will make China's dilemma much more manageable. But for now, the Fed is still going in the wrong direction. They're hiking rates, and this is going to make it impossible for China to come up with any kind of stimulus that I think even moves the needle meaningfully in terms of an economic outlook, which is very dire.
I mean, do Chinese policymakers have any options at all in your eyes?
No. The market seems to be hoping for Chinese policymakers to revert to the old model, which would be to take credit growth from 9.5% currently and jack it back up to 15%, build a bunch more bridges and tunnels and airports that they don't need, have state-owned enterprises invest in low or negative value-added projects, all these things which we know do nothing but kick the can down the road, okay? Xi Jinping is, in his mind, leader for life. He has no one to kick that can to. There's no better time than now to address that problem because he only makes it worse for himself, and he makes it worse in a way that, in his mind, I believe, will prevent him from achieving his overarching agenda for China, which is to make it one of the great powers of the 21st century, to have China's economic model be a competitive counterweight globally to the U.S. and the West, and all these, big picture things that he has in mind. Pumping up GDP to keep some unemployed kids happy is very low on his agenda. And I don't think people really grasp this, that he doesn't really care if they're annoyed because youth unemployment is 20% or whatever it is. He's actually made statements to the effect that they should go back to the countryside and, pick up a shovel, basically. A little hard work never hurt anybody. So the market wants them to revert to the old model. They're not going to do that. Barring that, there is no answer. Okay, Xi Jinping's answer in his mind is if they can just do better central plans, that would work. That this central planning authoritarian model still works. It's just it was corrupted by all this real estate craziness and local governments who are acting in their own interest and not the party's interest. And if he can corral that, really focus hearts and minds on putting together a better central plan, then the Chinese economy can still grow under this political and economic model. It's a fantasy, but I believe that's what he sees as the way out of this pickle, which means, in my eyes, they're not getting out.
So basically, what you see is the biggest factor is what the Fed does, right?
China has very serious homegrown economic problems, which might be able to be dealt with some marginal easing if the global environment was not so malign from China's perspective, right? If the Fed starts cutting rates and the dollar falls a lot and global commodities boom, then the RMB will strengthen. It's easier for the People's Bank of China to ease monetary policy into that scenario. PPI is getting natural uplift, and all of these problems are a little bit exacerbated. So the external environment is like a straitjacket, which is going to prevent China from taking effective measures to address their homegrown economic problems.
Do you think these economic problems could reach a point that is unreversible, even if the global environment becomes better?
Yeah, I think it is irreversible in the absence of a move to a new kind of economic system, or what people broadly used to call reform, right? Which we all know is simply incompatible with Xi's vision for how he wants to run the country, because reform ultimately, necessitates a surrender of power over resources on the part of the CCB. They have to let the market allocate resources, but that's frightening to them. So that's not going to happen. So with this government and this form of government and its views on how the economy should be managed, this only gets worse in my book. This is a one-way street to negative GDP growth at some point, maybe sooner rather than later, but certainly in the next couple of years.
But if China is in a deflationary environment, could that situation actually benefit the U.S.?
Well, it depends on your framing here. If you're in the framing of a great power struggle, then we benefit from problems in China's economy. Yes, and frankly, because China doesn't really purchase much of anything anything in terms of final products that are made in the rest of the world are very small. It doesn't really hurt the West if China's growth sucks wind, basically, which I think it's going to continue to do. So from that perspective, I don't think the West is going to be under any pressure to do anything to help China out of this pickle. The one thing that could change that, if we start to see precipitous declines in the RMB, and then that transmits China's problems to the rest of the world, because they're sort of trying to devalue their way into competitiveness, steal growth from the West, and that kind of thing could trigger some serious global asset volatility. But more recently, the Chinese authorities have pushed back against RMB weakness. I'm not sure why they are pushing back against it. A debt deflationary economy needs a weaker currency. Any bit of reflationary fresh air they can get, they should take. So I think they'll be okay with the weaker RMB, but if it weakens too rapidly, then it tends to undercut domestic confidence, and they're afraid of a 2015, 2016 scenario where it gets out of control, looks very sloppy, and starts to further damage domestic economic confidence. So right now they're pushing back against the RMB, but if the Fed, continues to tighten monetary policy or maintains a very tight stance into a U.S. slowdown, for instance, and we start to see credit events, maybe more banking stress in the U.S., credit events in Europe, which tighten global liquidity, and the Fed doesn't respond, then you could get the kind of strong dollar move that would push the RMB rapidly towards 8, and then we have an international crisis on our hands. It's not happening now, but I think that's a live risk for the second half of this year.
Thank you so much today, Brian. It's a pleasure speaking to you.
All right. Thanks, Don. Take care.